Bloomberg Audio Studios. Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
One of my favorite economists of all time is Yelena Shulyatyeva, senior U.S. economist at the Conference Board. Yelena, thanks so much for joining us here. What did you make of the Fed's move this week? Was that appropriate, do you think?
I think so. I think there's a lot of tension. Obviously, it was not an easy decision. You absolutely hear that in the press conference. A lot of tension going on between the inflation goal and the maximum employment target. But I think they did what they did was appropriate. We think that they will continue to cut rates this year. We have two more cuts in our forecast, and we also have two cuts in the beginning of next year. I think it's a risk management decision. It was all very clear throughout Chair Powell's speech, the press conference, that it was a risk management decision. A lot of people said that there was a lot of tension between upgrading the economic projections and the rate cut. But actually, if you look at the materials to the summary of economic projections and you look deeper into the risk section, the risks to the labor market increased substantially, while the risks to the inflation mandate as a perception between FOMC members actually declined. And that is what drove the rate cut. It's the balance of risks shifting, not necessarily their projections for the economy.
But Yelena, Powell said himself, this is not a bad economy right now with unemployment at 4.3%. The economy is still growing at about 1.5%. So how many rate cuts do you think we should be, not will get, but should get in 2026?
Well, we're still in a restrictive territory, he said, right, at the same time. So it's not necessarily like cutting rates to boost economic growth. It's really removing that access restrictiveness from interest rates. I think, we're expecting 4 more cuts and for the Fed to stop at 3% and see and assess what is happening in the beginning of next year. Why the beginning of next year? It's going to be a really pivotal moment for the economy. We think that we have not seen most of the impact from tariffs just yet. There's a lot of discussion on Bloomberg TV and Bloomberg Radio about, how tariffs have not yet fully been felt throughout the economy. I totally agree with that. It's going to be the holiday season that will be a huge test for the U.S. consumer in terms of their tolerance to higher prices. I think that's when we're going to see how consumers are doing. And in our own projections, we see a significant slowdown in the economy towards the end of the year just because of that and going into 2026. So that's when we are going to see the significant impact from tariffs, which will probably not be fully offset by fiscal policy and that a lot of people talk about.
Yelena, the Fed seems to be, I focus maybe a little bit more on the labor side of their mandate. What's your view of the labor market these days?
It's healthy. It's weaker, but it's still healthy. And that's why I think the next payrolls report will be really key to what the Fed does at the October meeting. So, and it's not going to be about payrolls. And again, Powell alluded to that. He was kind of like, okay, yeah, payrolls, we agree that, that may not be the perfect indicator of labor market health. It's going to be about the unemployment rate. He did say a couple of times during his press conference that is the key measure for the Fed to see what is happening in the labor market. If the unemployment rate rises, and we will be very much looking at the details below, the unemployment rate itself, what drove it up and things like that. But if that rises, I think the Fed will continue to remove that restrictiveness from interest rates.
Yelena, you were talking about the consumer and consumer spending a moment ago. Despite some consumer confidence reports that show confidence is lagging, we're still spending, right? And today there was even a report from the National Retail Federation saying they expect record spending on Halloween this year. So when are we going to start to see the consumer pull back in some sort of a meaningful way? Because let's admit, they've really been the pillar of this economy, despite the tariffs, despite geopolitical uncertainty. They're hanging in there.
Well, you're asking a question, and as a consumer, I can absolutely understand it. Like me, myself, shopping for school supplies earlier this year, it was like, little notepads and things that went in price so much. I was shocked. Obviously, I'm not happy about it, but I was still buying it. So this is like a question about that consumer tolerance level that I think we will be testing towards the end of the year when we get into that important holiday shopping season. I think, to a degree, we're already cutting on services spending to buy those essential goods. And that's why I will be looking at the personal income and spending report towards the end of the month on September 26, to see what the split is between the services side and the goods side. I think that we have already, like the data shows that we have already diminished our spending on, particularly discretionary services. Let's see if that trend continues.
All right, Yelena, thank you so much. We appreciate that. One of my all-time favorite economists, Yelena Shulyatyeva, senior U.S. economist at the conference board here. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Let's see what's happening in this market here. Again, a little bit of lift in the market. We had a nice trading day yesterday, a little bit delayed response to the Fed cut here. Let's talk to somebody who actually is a professional in this stuff. That's Sarah Hunt. She's a partner and chief market strategist at Alpine Saxon Woods. We just kind of pretend here, but Sarah's the pro here. Sarah, what did you hear from your Federal Reserve this week, and did it alter the way you're thinking about allocating capital here?
Well, I think that they did the best job that they could in a circumstance that's challenging for a lot of reasons, because you've got the labor market doing one thing, you've got potential inflation coming back on the other side, you've got a lot of different things going on. Are we too restrictive? Are we not? Is a lack of restriction actually going to be helpful for businesses, and whether or not that goes anywhere? I think that there's no actual next step. The expectation is they're going to continue cutting, but you've got some data in between now and then. So I think they did the best they could in a situation that's quite tough, and it's only going to be tougher as the meetings go from here.
I think getting lost in the sauce, guys, is that there is a government shutdown looming. If that were to happen at the end of the month, how does that play into? I mean, it's really on the back burner right now, but if it were to happen, how does that inform your decisions on the market?
I have to say that generally speaking, a lot of that political conflagration doesn't always come through in markets because they assume that it's going to get solved. And historically speaking, it has been. We're also on year 30 of continuing resolutions, right? If you and I did that, our budgets would be completely a disaster. So the idea that all of a sudden this one is the worst one that we've had is, we'll see how that plays out. It certainly could add to volatility at a time when people are expecting volatility. And so far in September, we haven't really gotten very much of it. So it could certainly add to uncertainty, which would potentially be an issue for investors at record highs.
Red headline crossing the Bloomberg terminal. President Trump holding a phone call. That's according to the CCTV. We'll have more reporting on that. Sarah, talk to us about just kind of how do you think about U.S. versus rest of the world in terms of opportunities? Because we saw earlier in this year, a lot of folks kind of leave the U.S., maybe kind of back away from that American exceptionalism a little bit. Like, I got to own everything, the dollar, I got to own U.S. equities, U.S. bonds. Kind of backed away from that. How do you guys think about that now?
We tend to be fairly U.S.-centric, and I think the tricky thing about backing away from it, there are periods of time at which different markets will do better than the U.S. for any number of reasons. I mean, I think China, with stimulus, the Chinese market's actually done quite well this year. But I think that the problem becomes, if the U.S. has a problem, the rest of the world tends to have a problem as well. Most of the large technology juggernauts are in the United States. Most of that cash generation is coming from there. So it's difficult to walk away from the U.S. It's more of an and than an or, as far as we're concerned. There are places where you can find pockets of timing where you can make more money, but the U.S. markets really tend to be a place for investors to sort of stay and hold those stocks.
Are you surprised by the strength you're seeing in China right now and the low inflation you're seeing in China, given all that's coming at them, right, especially from the U.S.?
I think it's a surprise. I mean, this year has been such a challenge to try to parse out where things are going, because you've had this moving tariff situation. You've had a lot of that. That makes it very difficult for people to figure out exactly where things are going to go. So I think you look into 2026 and it's as confusing what's going to happen next year. But China has certainly been trying to do work on their own economy, and that's been a sort of a perennial. But this year does seem to have been a little better for them.
Sarah, what do you talk to your clients about? Is it when they say, boy, I'm concerned about this concentration risk in this market? I mean, it seems like all the performance is driven by a handful of names, but yeah, I know most of the earnings are coming from a handful of names. But we just haven't seen it like this for such a long time. Tom Keene would go back to the Nifty 50 back in the day.
That is also a very big challenge. And the problem is that it's almost the momentum has been driving a lot of that, but it's also the cash flow and the earnings that have been driving that. It is hard to see where you can look at ancillary areas, and we've talked about this before in the space of infrastructure build out for AI, but there's also that spending is enormous right now. That spending doesn't look like it's slowing down. When it does look like it's going to slow down, I think you're going to see a lot of wobbles. And every time we think that there might be a pullback in AI spending, that part of the market has wobbled. But it's difficult because that is where the performance is, and that is where the concentration in the S&P is too. So if you're going up against the market, quote unquote, as the S&P 500, that concentration in top names is enormous in that index, and that is historically unusual.
Headwinds in this market, I mean, besides maybe valuations being a little frothy in some areas, what's the biggest headwind to the market?
I think the biggest headwind to me is any kind of risk to earnings growth, because the valuations in and of themselves are usually not the problem. The problem is when something changes. And if that delta in that change in earnings direction goes the other way, it's either negative or it starts to slow down, that's going to be a problem because of where valuations are. But the valuations in and of themselves are not as much of the issue.
What would be the impetus to make those earnings go down?
So this is the problem of where do we end up with the tariffs and what happens with margins, because margins are a big problem. If you are worried that input prices are going up, then you have a problem with the labor market, because that's usually how people solve margin problems.
Right.
I mean, the second quarter earnings were, I don't know, really good. I mean, much better than people had expected. But I keep waiting for the tariffs to really bite earnings, and we just haven't seen it really.
It's that shoe that people are either waiting to drop or assuming is not going to drop because it hasn't dropped thus far. Okay. And I think that's where the problem is. And with the moving rules and timing, you can just keep pushing things forward, and then people keep bringing forward their activity because I'd rather buy it now than pay an extra 20% on it. At some point, that script either flips or it doesn't work quite as well. And we haven't gotten there, which is why earnings were so great and people were surprised, and those upside surprises were. I think the expectation is that earnings are going to be higher in 2026. If that expectation changes, I think that's where you start to see the cracks in the firmament.
I think it all comes down to the consumer, right? We were all buying up cars early in the year to get ahead of the tariffs. I mean, once the consumer starts to pull back, if this job market cracks in a larger way, right, that's when the dominoes will start to fall.
That's part of the problem, and that's part of what everybody's been waiting for. And there is a striation between upper-end consumer and lower-end consumer, and the lower-end consumer has been hurting for quite some time. The upper-end consumer continues to spend.
Sarah Hunt, thank you so much. Appreciate it. As always, Sarah Hunt, she was on television earlier. Now she's on there doing it all. Multimedia. We'll have to get her on a podcast or whatever the kids are doing these days. Sarah Hunt, partner and chief market strategist at Alpine Saxon Woods, giving us her thoughts on these markets. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Hessam Nadji, President and CEO of Marcus Millichap, joins us here in our studio in New York City. Hessam, talk to us about the commercial real estate business here today. How are things out there?
Good morning. Great to be with you. Again, we have come a long way since the shock of a 500 basis point interest rate factor completely destroyed any notion of underwriting or how you value commercial real estate in 2023. 24 was a little bit of a regrounding of those values, and 25 is now moving forward into a new cycle. And the Fed's move yesterday continued that process for this industry. Prices have adjusted, which is a really important reason why capital is coming back into commercial real estate on a replacement cost and alternative asset basis. Today's commercial real estate is far more compelling as an investment than it was even a year ago, especially with the Fed now becoming much more dovish. We're also seeing a big pullback in new construction starts, especially for multifamily housing, which had record production. And that drop in new supply will give the market some time to recover.
Let's talk office vacancy rates, right? Because there was all that doom talk. Nobody's ever going to go back to the office. Right. People are going back to the office, mainly because a lot of companies are saying if you don't, you can hit the road. Where are office vacancy rates now? Because I know across much of the country, they were at record highs recently.
Great question about a property type that has really suffered from the post-pandemic ripple effect that is now finally starting to recover. You're right. Overall vacancies are around 17.5% nationwide, down from north of 20% just a couple of years ago. In New York City, those vacancies are accelerating on their way down now. We're seeing a full percentage point drop in vacancies over last year, record absorption in Q4 and Q3 of last year, leading to a really strong 2025 for the market. What's interesting is that the daily attendance of office workers is now at 80% of pre-pandemic levels.
Lisa Mateo.
Up from 70% last year and 57% the year before.
I call that resilience.
Yes, it is.
Right?
But there's been a lot of pain in the process. A lot of properties have defaulted on their loans. And the bifurcation of older obsolete buildings versus Class A, newer, more modern buildings is huge. Vacancies in the Class A newer product is, 11, 12% or so. And by comparison, you're looking at 25, 30, 35% vacancies in older, more obsolete properties, especially in urban markets. So it's a tale of two cities. And the reaction from the market to commercial real estate being the next shoe that falls because of office defaults was way over exaggerated. I've been on this program saying that for a couple of years now. And that's proved to be right. We're working our way through it.
Yeah.
How about the financing side of the commercial real estate business? Are the banks playing? If I want to go develop something or redevelop something and I want to put some capital into commercial real estate, where am I going to go? Am I going to go to my local bank? Where am I going?
Normally, the private investor, sub $10, $15 million price point, heavily relies on banks and credit unions, especially regional and local banks. In 2023, after the Silicon Valley banking crisis and first half of 24, banks were not lending. Underwriting was very tight. That has changed significantly this year. So the banks are much more active. The normal rotation of loans being paid off, maturing, is finally starting to recover. That opens room on their balance sheets for new loans. And that's another reason we're bullish for 2026 in terms of more transactions and refinancing.
You mentioned a moment ago about how these older buildings are having a hard time finding attention in the market. A number of cities are turning those buildings into those commercial buildings into residential buildings. We're seeing that in Cleveland. We're seeing that in Boston. Is that a trend that you think is sustainable?
It's a one-off trend because the cost of those conversions and the practicality of most of the footprints that were designed for office use into a true residential use is very limited. But there are some successful examples. What we're seeing broadly is the reuse of old retail, for example. shopping malls that are obsolete are a lot easier to either demolish or convert to something else than urban, especially urban office buildings.
Where are you guys seeing the best value out there today? Where are you guys seeing, well, maybe some of the smart money going, if you will?
Multifamily rentals, apartment buildings were so much priced to perfection before the Fed's interest rate hikes that they were affected pretty severely. So was industrial warehouses. Those were the two most, let's say, price to perfection property types that were affected dramatically by the interest rate factor. It's now 2.5 years after that shock. Prices have adjusted. And because of the replacement cost comparison being so much higher than the existing valuation of existing assets, those two property types are still getting a lot of attention. And believe it or not, retail is the comeback kid.
Really?
15 years of e-commerce revolutionizing how consumers basically buy things made brick and mortar retail, go through a massive kind of repositioning. And today's retail has less footprint, more of a customer focus and experiential retail focus, and it's doing very well. I would say it's the most desired property type of all the different property types that our company brokers.
Well, you know what's interesting? In my neighborhood, and I'm Midtown East, for years I walked past empty storefronts. And it just seems like all at once somebody got in a room and said, let's start buying because things are starting to pop up all around. Is that just, my enclave on the Midtown East?
It's not. Even urban retail right here in New York is starting to do much better. It took several years before that demand started to come back. But it's fascinating to see a property type that was left for dead because of e-commerce now be the darling of the industry.
You're in Calabasas, California, right in L.A., King's Fish House. I'm a big fan. Talk to us about the L.A. market. What's happening there in commercial real estate in L.A.?
Well, we're finally recovering from the devastation of the fires, and there's a lot of pressure on jobs because of tariffs and the port activity. But the market is holding up surprisingly well against those two headwinds, in that California as a state, and Southern California in particularly, was sort of viewed as the diamond in the rough in the last 6 months, in that there's been so much controversy, both political and non-political, that a lot of investors shied away from investing in properties there. We're seeing a reversal of that because the yields are now, on a comparative basis to other markets, pretty attractive. And, let's face it, Southern California in particular is very dense, and you have the diverse economic base of trade, entertainment, education, and all the reasons people are still attracted to Southern California. And the outmigration of California is way overstated. It's not nearly as bad as people feel about it.
Yeah. We had the CEO of the Port of LA here yesterday, talking some Bloomberg intelligence. And, they're dealing with all the day-to-day changes in tariffs and the import taxes and what have you. But it seems like business is humming along.
It is. That's what we're seeing on the ground as well. And new capital is looking at buying assets. Throughout California.
Hessam, thank you so much. Appreciate it. Coming in, as always, Hessam Nadji. He's the president and CEO of Marcus and Millichap. It's a publicly traded company. MMI is the ticker. Giving us the lowdown on commercial real estate. We appreciate that. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
It is that time of day again. The highlight of the 7 o'clock hour. Newspapers with Lisa Mateo. Lisa, what do you have for us today?
Okay, this is from the New York Times. It's kind of a man versus woman story when it comes to your health. So it talks about these different studies, right? How 40% of adults in the U.S. have obesity. Men have similar
40%?
rates. Yes, 40%. Dude. I know. That's a big figure there. Men have similar rates of obesity as women, right? But here's the way the story is structured, is that men are less likely to seek medical care. And this is the issue that's starting to happen. I mean, fewer of them get the bariatric surgery. Fewer of them are on anti-obesity drugs. And when they are on them, they get off faster than women do. Okay. They're saying maybe it could be a reason because women are more concerned about how they look. That might be it. But they're talking about the consequences. And the article really gets into it, how it tends to be more deadly for men than women. Obesity does. does. So it goes into all this, and this is like the fight in my house. Getting my husband to go to the doctor. Like, what is it with you men?
I don't know about you, but like, I'll stop for directions. Well, now we don't have to because we have Google Maps and those kinds of things. But I'll actually say to somebody, I need help. Where am I going?
Yes.
Where the guy, not so much. I think that's sort of the same dynamic at play.
You know what? I think you're onto it.
So you want the old man to do GLP-1, or you just want him to go to the doctor?
Just go to the doctor, get checked out.
Like, you got to do that. He doesn't do the once a year thing?
No.
No.
Have a talk. Thank you.
All right, what else we got here?
Okay, so this one is from the Wall Street Journal, and this is for the cat moms and dads out there who have all the cats at home. A lot more homeowners are spending a lot of money on outdoor patios for their cats to let them roam around, keep them safe. Patios, yes. Oh my God. It's a thing. People are spending $125,000 on these patios for their cats. You have to go on the article and see some of the videos. It's incredible.
I looked at it.
How they span, like, outdoors.
Pretty intricate.
And they just go up and down, and it's like hundreds of feet and all screened in.
Oh my goodness, I'm looking at this article. And
hundreds of feet to keep them enclosed.
I'm coming back as a cat, just so you know. That's what's happening.
So, I mean,
it's crazy.
Just protect them from, like, animals?
Yeah, coyotes. Okay. Coyotes are a big thing because people are afraid to kind of let their cats roam.
I see.
So now the cats can roam all around in these enclosed.
All right, folks, you got to look at this Wall Street Journal. Yes. I'm reading through the pictures and the video here are unbelievable.
But more people actually have cats. You know, cat ownership rose by 23% in 2024.
We were talking the other day, people are spending more on their cats than their dogs.
Why is that?
Yeah, they're having cat birthday parties. They're doing it's a whole thing. I'm telling you.
All right.
Maybe they're just easier to take care of. You don't have to go out and walk them.
True.
I don't know. I'm allergic, so we move on.
No cats in your house.
No cats. Definitely not. Okay, so a number of companies we've heard, like retailers talking about tariffs, higher cost of living, and that's going to affect consumer spending. Well, apparently consumers are willing to spend on Halloween. Okay, they're not scared about it. National Retail Federation says Halloween spending is expected to climb to a record $13.1 billion this year. Wow. And consumers know they have to spend more. Per person spending increased to you're going to spend about $114.45. That's what they're saying. It's about $11 more than last year. But where their spending is changing, they're going more to the discount retailers, spending more of their money there. The biggest category, for spending for Halloween is candy, because you have to get the trick-or-treaters, right? Total expected to be about $3.9 billion. I don't get many trick-or-treaters anymore. I don't know either, but you know what? Some people do.
People spend. My takeaway from you this morning is people are spending on their cats and Halloween. Don't get in the middle of them and their Halloween candy.
Oh my goodness!
It's true, but we're where the best place to go Halloween trick or treating, according to my daughter.
Yes,
Summit, New Jersey.
Is it?
Well, they give out the big candy bars.
Yeah, and the thing in Summit, the parents are great. They'll have big bar setups outside their house.
Yes.
Cocktails. So it's just. I remember when my kids were little, we used to do all that. So. That's a good time. Yeah, people love the Halloween thing. My niece is a crazy Halloween person.
And
otherwise, a normal person.
The full bar of chocolate, not the little big bite size.
Yes, not the bite size.
Right. And there's got to be a cutoff. 12 years old, 13 years old. I don't know.
No, the teenagers do it.
I know. All right, Lisa Mateo, that's it with our newspapers. Some good stuff there.
This is the Bloomberg Surveillance Podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.